The stock market is something that most people are told to go and invest in at one point or another. Not the least of which is because it can be a great way to take a small amount of money and make it larger should certain things go your way over time. The problem, though, is that the market in and of itself is something that can confuse anyone who is not in the know or has studied it for a long time. So let's help you with that as you get started on your own journey. Allow us to show you stock market terms you should know for beginners. Be sure to like the video and subscribe to the channel. Ticker symbol. A stock's ticker symbol is a set of letters, usually an abbreviation for the stock's name, that is used to identify that particular stock in the stock market. Ticker symbols usually range from 1 to 5 letters in length. For example, Facebook's ticker symbol is FB, and Microsoft's ticker symbol is MSFT. Some companies even have multiple classes of shares. For example, Alphabet, the owner of Google, has 2 share classes available to the public. One with voting rights, GOOGL, and one without voting rights, GOOG. If you're starting out with some stocks, you'll want to know the symbol so that you can pay attention to certain things, as many places only use the ticker symbol instead of stating the stock itself. It might be a little hard to first remember them all, but over time, you'll get there. S&P 500. The S&P 500, or the Standard & Poor's 500 Index, is an index consisting of the 500 largest publicly traded companies in the U.S. by market cap. The companies in this index are all weighted depending on how large they are, and these weights are combined to produce a number which indicates the performance of the index. The companies with the highest market cap affect this number the most, while the smallest companies affect it the least. The S&P 500 is widely used as an indicator of the performance of the stock market as a whole, since it includes so many stocks in so many different sectors. Oftentimes, when people talk about the market performing well or not so well, they're using the S&P 500 or another popular index like the Dow Jones Industrial Average as their benchmark. This one will be easy to remember, as will this next one after some use. Bull and bear. When it comes to investing, the terms bull and bear can be used to describe how the market or a particular subsection of the market is performing, or to describe investors' feelings about the market or about certain stocks in particular. A bull market is a market in which stocks are gaining value overall. A bear market is a market in which stocks are depreciating in value. To be specific, a bear market is defined as a market in which stocks have fallen 20% from recent highs. Bear markets are often accompanied by pessimistic investors, a slow economy, and a rise in unemployment. Bull and bear can also be used to describe how an investor feels about the market or a particular stock. If an investor is bullish on a stock, he or she believes that stock will rise, while a bearish investor thinks that the stock will fall. Can you guess how the terms bull and bear came to signify rises and drops in the stock market? The most common belief is that they actually come from the way bulls and bears defend themselves from predators and hunt prey. Bulls thrust upwards with their horns, which is why bulls are used to signify upward trends. Bears slash downwards with their paws, so they are used as a symbol for downward movements in the market. See? And you thought that there couldn't be anything fun associated with the stock market. Market cap. Market capitalization, or market cap, refers to a company's overall market value at any given point in time. The word market indicates that we will use the market price of the company or its current stock price in the calculation. The word capitalization is a term that can be used to describe the size of a company. Market cap is calculated by multiplying the current price of the company's stock by the number of outstanding shares. Outstanding shares are shares of the stock that are currently held by investors. For example, if a company has issued 1 million total shares of stock and each share is worth $5, then the market cap of the company is $5 million. The market cap of a company changes constantly, since the price of its stock is always fluctuating. Market cap can also change when the number of outstanding shares changes, such as when a company issues more shares of stock or even buys back its own shares. But that doesn't happen very often, which is why the stock price is the biggest factor determining changes in market cap. Volume. The volume of a stock is pretty much what it sounds like: the number of shares of the stock that change hands in a given time period. Volume is an important statistic for investors and traders alike, but it's especially important for stock traders who use technical analysis, which we will talk about at the end of the video. It's important to pay attention to the volume of a stock because you want to make sure that it will be possible to buy or sell a share of the stock if you so choose. For example, blue chip stocks are very high volume. Millions of people buy and sell shares of them every day. So if you want to buy or sell a share of a blue chip stock, you can pretty much guarantee that there will be someone on the other end of the transaction willing to buy or sell it. But if you were considering investing in a smaller stock with a low trading volume, there's a higher chance that you won't be able to find someone to take the stock if you decide you want to sell it. Stop loss. A stop loss order is essentially a safety net that can ensure that you don't lose more than a certain amount of money if a stock you own starts dropping in price. When the stock price drops to your specified amount, it will trigger the stop loss and automatically sell the stock. For example, if you buy a share of a stock at $100 and decide that you don't want to lose more than 5% of your investment, you would set your stop loss order at $95. If the stock price drops to $95, your brokerage will automatically sell the stock for you to prevent you from losing any more money. Stop losses can be very useful for locking in profits as well. Let's say you've already made 10% from a holding stock and you want to keep making money without sacrificing all those gains. You could set a stop loss at 5% less than the current stock price, which would ensure that at the very least, you will make 5% from your original investment. But hopefully, the price will keep rising and you can reset your stop loss to lock in even more profits. While stop losses can be a very useful tool, they are not for everyone. If you're 100% committed to a stock and you know that you are going to hold on to it no matter what happens to the price, then a stop loss will not be necessary. But if you're holding a stock that you've already made some gains on, or you might lose some money on, and you want to make sure you can sell the stock if it drops to a certain price, then a stop loss order is the perfect tool for you. ETF. An ETF, or exchange traded fund, is a security that is made up of a bunch of different securities, all bundled into one package. Many ETFs track an index or sector of the market. For example, one of the most popular ETFs to buy is one that tracks the performance of the S&P 500. If the S&P 500 gains 5% in a single day, then you gain 5% on your investment. You can also buy ETFs that track technology sector, the financial sector, bonds, and many other things. ETFs are essentially cheaper, more accessible versions of hedge funds. Rather than having to pay a lot of money to invest in a hedge fund that is very hard to buy and sell individual shares of, you can trade shares of ETFs on the stock market just like a regular stock. They are cheaper to buy, easier to trade, and involve much cheaper fees than mutual funds. All in all, ETFs are a great way to achieve diversification and exposure to different parts of the market without spending too much money. So, what do you think? What do you think of this look at the stock market and the various terms that you should know if you're looking to start investing in it? Does this guide honestly help you out? Are you more confident going and trying to invest in the stock market now that you know some of the terms? Which ones did you know about ahead of time? Let us know in the comments below. Be sure to subscribe and we'll see you next time on the channel.